have not just one research analyst, but all the research analysts on the call. It's made available to the public. They're to be really relying only on public information in doing their business. Folks on this side should not be doing their job using non-public information. The Chinese wall is really set up to avoid conflicts of interest between these two groups. Probably one of the most obvious examples, if you go back to the tech boom of the late 90s, a lot of small technology companies were going public. Right? Capital markets bankers were obviously involved in those transactions, helping take a company out, helping make a market in their shares. What was happening is they were oftentimes engaging in something called pitching research. That is, they bring a research analyst in with them and say, if you give us the capital markets business, you let us be your lead underwriter on your IPO, my research analyst Henry over here is going to cover you with favorable coverage for the next several years or whatnot. All right. Obviously, some conflicts of interest there, artificially keeping stock values high. All right. That practice of pitching research, completely illegal now, no longer allowed. This Chinese wall, this firewall helps avoid some of that. And again, when we say bulge brackets, we're referring to full-service investment banks as contrasted with boutiques. Boutiques are really focused on offering a more limited number of products and services. And in many cases, they're much smaller investment banks, but not necessarily. Okay, some boutiques, think of Lazard. Lazard is actually a very large investment bank. It's a public company, but they've really kind of made their focus M&A, doing restructuring work as well these days. All right, they would be considered a larger boutique. Some other boutiques, firms like Greenhill, Centerview, Evercore, Blackstone, some of these actually have kind of risen up in recent years, been formed by ex-Wall Street folks who used to work at Goldman or what have you. They've spun out, created these boutique banks. If you're looking for jobs, these would not be a bad place to look right now. Okay, boutique banks, because most of them are oftentimes smaller, most of them do not maintain the large training programs that the bulge brackets maintain. Okay, so when people get hired there, they don't get put into a room and trained the way you're about to get trained. They want to hire people who've already gone through that. Okay, so by the time you're out of this class, based on the fact you've gotten some training, that would make you much more appealing to the boutique banks. Okay, some boutique banks, notably Miller Buckfire, notably Houlihan Lokey, have major focus on restructuring. Okay, these are very, very busy banks these days. They're growing very quickly. I have seen job postings by both of these companies. So these would be other places that I would recommend looking if you're looking to break into investment banking right now. Okay, and they're not necessarily small banks. These banks have, in the case of Houlihan anyway, they've got offices nationwide. And some banks, some boutiques focus only on particular industries. Allen & Company is a media bank. Petrie Parkman used to be oil and gas. They were acquired by Merrill, which is now B of A. Right. There's a tech bank out in Silicon Valley, out in San Francisco, called Thomas Weisel Partners. Focuses pretty much entirely on technology companies. All right. So those are boutiques, and then sometimes you might have a further distinction for what we call middle market banks. And that's where we're definitely talking about banks that focus on smaller transactions. Generally speaking, we're talking kind of below the $500 million mark in enterprise value. All right, so these banks can kind of play in that space. You might have a further distinction below 50 million, which might be called lower middle market. And that can be, sometimes that can be a guy working out of his house. Sometimes it can be a collection of just 2 or 3 people providing advisory services to smaller companies. Now within the investment banks, and probably this hierarchy here is probably a little more typical of a bulge bracket investment bank. You've got several different levels. Right? At the very top, managing directors, folks that are really focused primarily on bringing in new business. It's kind of a rainmaker role. All right, we'll talk a lot about their role when we get into the pitching discussion later. All right, but they're primarily focused on bringing in business. Sometimes you might see a director title at an investment bank. Not all banks have the director title. I know Deutsche does, but not all do. It's kind of an MD or MD in training type of position. Okay. The next most senior position, typically vice president. A VP at an investment bank is primarily responsible for execution on transactions, kind of a project management role, day-to-day contact with the client, overseeing what's going on at the junior level of the bank, that is at this level, which we're going to talk a lot more about in a minute, but really an execution type of role. All right. Once the business is won, in a lot of cases, the MD really kind of takes a back seat. They're out trying to win the next deal. They'll stay involved on the periphery and obviously get involved if there's a problem, but the VP kind of takes over at that point in the deal process. Okay, and then really more the focal point of this class, we've got junior bankers, which is pretty much everybody below the VP level. Analysts, associates. Analysts are folks that are typically coming straight out of undergrad, going to work in an investment bank's analyst program. Those are typically 2-year programs. First thing they do is usually they get dumped into a room like this, and they get exposed to 4 or 6 weeks of intensive training, kind of like what we're going to do. All right, and then the good ones, the really exceptional analysts after 2 years might be asked to stay on for a 3rd year. Sometimes they might get promoted to the associate level, but by and large, it's a 2-year program. Most analysts, after 2 years of working at a bulge bracket bank, they're ready to get out. They're ready to go work in private equity, go work in a hedge fund. A lot of them go back to business school. Okay, after 2 years of 80, 90, 100, 120-hour weeks, they might want to just become a poet. Who knows? It's a pretty grueling lifestyle on Wall Street. All right, but they are basically doing the work, the financial analyses that we're going to go through, putting together a lot of presentations, helping put together pitch books. On a live deal, they'll take on some more of the administrative responsibilities, setting up conference calls, document delivery, that type of stuff. But that's kind of an analyst. And they typically report up to an associate, which is usually someone who's come out of business school, they've got an MBA. Again, sometimes it could be someone who got promoted directly from the analyst pool, but typically these are folks out of business schools that are overseeing typically a pool of analysts, all right, giving them work to do, guiding them, mentoring them, checking their work product, sometimes even getting involved in building some of the more complicated, complex models that they might have to do. And a lot of boutique banks might have a similar structure as well. I think boutiques, especially the smaller ones, they may not have all of these titles. Boutique I worked at didn't have an analyst title. Everybody came in as an associate. There was no director title. It was basically associate, VP, and managing. It was a partnership, so managing partner. All right, but similar types of roles and responsibilities. All right. So let's talk a little bit let's start talking about the buy side of the industry. First, I want to talk about the debt side of the industry, some of the types of things that debt investors do. Basically, when we say debt, we mean they're providing a type of obligation or financing that is an obligation to be repaid. Anytime we have debt, it comes with something called interest expense. And there's a number of different forms of debt out there. The very most senior type of debt, the safest type of debt, usually provided by the commercial banks. Banks like JP Morgan Chase, Bank of America, PNC Bank, those types of groups. And that safest type of bank loan is what we call a senior secured bank loan. The lender would take a first priority lien on the assets of the company. All right, so in the event of a bankruptcy situation, they would be basically first in line to recoup the monies that they've lent to the company. All right, they're the senior creditor. Because they are in the safest or the most senior position, it's got the lowest interest rate. It's usually the cheapest form of debt, but it's not always available to all companies. Okay, some companies end up being what we call non-bankable. And they usually come to a company like mine where we'll lend to companies that have kind of substandard, that would be a substandard asset in a commercial bank. Okay, but again, lowest interest rate of all the different types of debt, usually priced off of something called LIBOR. What's LIBOR?
London Interbank Offered Rate.
London Interbank Offered Rate. It's basically an interest rate index it's something that is used when banks lend money to each other. It's also something we use to price loans. All right. Below the senior debt providers, below the commercial banks, you might have varying levels of junior debt. That is maybe second, third lien loans, maybe high-yield bonds that get issued in the public market, maybe private placements, that type of thing, can be provided by a whole different host of different investors, maybe hedge funds, insurance companies will provide junior debt in many cases, pension funds, that type of thing. And because they are a bit junior to the senior secured lender, they're in a higher risk position, so they usually have a higher interest rate associated with this debt. Okay, if a senior bank loan is charging interest at 6%, you might see junior debt 8, 9, 10% kind of in there, all right, to reflect that increased risk. And again, it all gets back to a bankruptcy. If they're first in line to get paid out or to recoup their losses, whatever's left then flows to the junior and debt holders. Sometimes they may not be able to be made whole. That's why we say they're in more of a high-risk position. Right, beyond that, what we've got is something we call mezzanine debt, often referred to as hybrid debt. We call it hybrid or mezzanine because it feels a little like debt on one hand, and there's typically an equity component associated with it. Right, this is usually what we call unsecured debt. That is, they have not taken a lien on assets, or if they have taken a lien, it might be a second or a third or maybe a fourth lien position. At any rate, it's very, very junior in the capital structure. And in that bankruptcy situation, they would be even further behind those senior creditors. Because they're taking on more of a risk and lending money to that company, they'll usually get a higher interest rate. And because of that risk, in order to compensate them for that, they'll take what we call an equity kicker, usually in the form of warrants. That is, they'll get some equity ownership in the company as well. If all goes well, they get paid their interest, they get paid their principal, and then they get a little bit more in the form of that warrant, whatever it ends up being worth. We're actually, when we get into leverage buyouts, we're going to model, I'm going to show you how to model mezzanine debt. All right, and the model we build, that mezzanine debt is going to have what we call a PIK structure. Who knows what I mean when I say PIK? P-I-K. Payment in kind. Instead of getting their interest paid on a cash basis, that interest expense gets accrued and added on to the ending balance, kind of like a negative amortizing loan in real estate, if you've ever heard of it. Eventually it gets paid, unless the company goes bankrupt. All right? Eventually it gets paid, but from the mezzanine lender's perspective, they don't know exactly when it's going to get paid. They might be hanging out there without getting any interest paid in cash for years and years and years. Right? Another reason that this ends up being a riskier piece of debt. And in this case, they're usually looking to earn total yields or total rates of return 15 to 20%. Sometimes it might be a little less than that. Maybe it's 12 to 15. All right, really kind of depends on the fund itself, the structure with their own investors, and the type of companies they're lending to. On the equity side, when we talk about equity, there's usually two different types of equity. You might have preferred stock, you might have common stock. It can be public, it can be private. Really kind of depends on the situation. Preferred stock is it sits a little bit above the common stock in terms of seniority. Oftentimes it might have a dividend associated with it. Oftentimes it might have more of a senior voting structure. So you'll see typically venture capital investors, when they invest equity into a company, they're typically buying preferred shares because it gives them a little more vote, gives them a little more control of the company. And again, sometimes there can be a dividend associated with that as well. And when we talk about common stock, we're talking about the absolute lowest priority in the capital structure. They are absolutely dead last in line in a bankruptcy situation. That's why equity, in many cases, ends up being worth nothing in a Chapter 11 proceeding. All right, obviously, we can buy stock in companies. We can buy stock in public companies, go on to E-Trade or one of those places. We can buy stock. Private equity firms, obviously, we're quite active in investing in companies over the years, buying different forms of securities, buying different types of companies, whether investing in private companies or maybe buying public companies and taking them private. Okay, and probably some of the household names here, the mega funds, KKR, Kohlberg Kravis and Roberts, Blackstone, Apollo, probably household names, TPG, Texas Pacific Group, to speak of a local private equity firm. Cerberus, those were the guys who got wiped out in the Chrysler deal. lost like 3 or 4 billion, something like that. Some private equity firms might be industry specific, kind of like investment banks that might have an industry practice. Some PE firms might just know a particular industry really well. Their principals might have worked in that industry, might have worked in an industry group at an investment bank prior to that. They might focus on energy or what have you. Okay, some might look more at distressed situations. Oaktree, Oak Hill, Cerberus would fall into that category. They're kind of distressed themselves these days. And then some might be looking at particular company sizes. Might look only at large companies. You think of a firm like Blackstone, I think their last fund was like $20 billion. If they want to get that all deployed, they're probably not going to be doing $1 and $2 million investments. They probably need to focus on doing bigger deals. All right, so they'll be kind of more in this large cap side of the spectrum. All right, but the smaller the funds, generally the smaller types of companies they'll look to invest in. Private equity firms are the ones who do leveraged buyouts. All right, when we do our leveraged buyout model, we're basically going to put ourselves in the shoes of a private equity fund and look at a sample transaction and figure out whether it would be worth doing. Okay, so we'll get a little private equity experience here in class as well. And then hedge funds, I'm not a hedge fund guy. I haven't worked in a hedge fund. I don't know the inner workings of them all that well, so I'll be brief on this. It is something, obviously, that's become more prominent in recent years. You hear of hedge funds every day. Initially, hedge funds were started really to hedge against risk, typically through what we call a long-short trading strategy. Buy some shares long, sell some shares short, and then try and manage your returns in a, within a limited range. Okay, hedge funds have branched out. Now they do pretty much anything. If you ever look at a hedge fund prospectus, they can do just about anything they want to do in order to maximize return to investors. Some will focus on particular industries. Some will have a product focus like convertible arbitrage or convertible bond arbitrage, something like that. Some, in some cases, they might look and feel a lot like private equity firms. It's hard to tell the difference. They might be buying equity just as though they were a PE fund. Some might be more activist hedge funds. You can think of Carl Icahn, kind of the way he goes about investing in companies. And some might invest really more in distressed types of situations. Really depends. The hedge fund industry till now has been kind of a black box. They can do whatever they want. It's probably going to change. Think of anything, the hedge fund industry will become more regulated going forward, not less. Okay, now let's talk a little more about investment banks, all right? Sell side of the industry, okay, but investment banks could be on the buy side or the sell side of a transaction. And that's why I had that initial slide up there to talk about it in the industry context. When we talk about sell side of a transaction, it means that the investment bank is representing a seller. Company decides they want to sell their business or they want to sell securities, they want to raise capital, okay? The investment bank would be the intermediary helping them do that. It would be the sell side of the transaction. Really a marketing process, by and large, packaging that company up for sale, marketing it to a specific network of buyers, trying to close a transaction on their behalf. Higher probability of closing, as long as what they're selling is desirable. Higher probability of closing because you've already got a willing seller at the table. It's just a matter of finding a buyer. All right, the other side is obviously the buy side of the transaction. In my experience, this has been a much lower probability of closing, okay, because you don't know if there's a willing seller out there. So the way this worked in my experience is when I was in banking, we did a lot of work with a just this big conglomerate, privately held, but big conglomerate. They did a lot of different things. They had a rope division, and they manufactured and sold industrial type ropes. Real exciting, right? They asked us to go out and find them other rope companies that might be interested in selling their business because they wanted to grow. And so my job as the associate was basically doing a whole bunch of cold calling, a whole bunch of research on the rope industry, and finding rope manufacturers and calling their CEOs and CFOs and seeing if they'd be willing to sell. Typically the response was, no, don't call me again. Got a lot of hang-ups. In my experience, not a more attractive, it was a much less attractive assignment, again, because of that low probability of closing. If you're going to work in banking, you want to work where the transactions are. All right, and the higher the probability of closing, the higher the probability of the bank getting success fees. The more success fees, the more bonus. All right, so you want to be close to where the transactions are happening, and in my experience, it was really more sell-side work that was a lot more interesting. Okay, but some people might look at it a little differently. Really, the big difference is that on the buy side of a transaction, if you're representing a buyer, you're not creating all that marketing, all those marketing materials. That's really what's time-consuming if you're on the sell side. Okay, but buy-side bankers also don't get paid as much. Buy-side bank's fee might